Good morning. Today we're going to cover global equities and the continued recovery we're seeing. Positive for investors is that we continue to see a broad-based global recovery in equity markets. The S&P 500, the main US equity market, is now just 4% off its all-time high, which was registered in February this year, and is now positive year to date. So it's been a remarkable recovery in global equities, and that has really been led or due to the rollback in tariff measures that we've seen from Donald Trump. Trump is very much wanting deals on trade with key trading partners. The easiest to get over the line was with the UK, which came through late last week. The more challenging would be with China, given China's dominance in global trade. On Monday, it was announced that the US and China had agreed to a 90-day window of lowering the tariff rates on each other. So the US reduced the tariff rate on China from 145% down to 30%, whereas China reduced their tariff rate on the US from 125% down to 10%. So a significant change, and has really buoyed equity markets again this week, and that's been most noticeable in the US. Thinking about the recovery that we've seen over the last 4 or 5 weeks, whilst it has been broad-based, it was European equities that led the charge most significantly, very much what we saw in the first quarter of this year. But over the last couple of weeks, we've seen a material rebound in US technology stocks. A number of reasons behind that. Firstly, they've reported their Q1 results, which were better than expected, and some of the stocks gave good guidance for the year ahead in terms of the amount of capital investment in capital that they'll be making in the coming years, but also reaffirming healthy demand for their technology. Yesterday, we heard from Donald Trump, who announced that Saudi Arabia would be pledging $600 billion in investments into US industries as they look to get access to cutting-edge AI technology. So that also supported strong returns from technology stocks yesterday. Whilst tariffs have been dominating market narrative over the last 6-8 weeks, economic data yesterday was back in the headlines, and it was on the positive front. US inflation report, it came in better than expected, coming in for headline inflation year on year at 2.3%. That's just slightly above the Federal Reserve's 2% inflation target. When we strip out volatile components such as energy and food prices, that came in at 2.8%, which was unchanged. So slightly better overall inflation data, which is encouraging. I suppose looking ahead, inflation is expected to push a little bit higher due to goods prices inflation, and that's because the effective tariff rate that the US has will go up, because some of the tariffs, whilst they're rolling back, there is an understanding that there'll be a broad-based lower tariff rate coming into place, which will push inflation up. So for the Federal Reserve, they may have to be a bit more patient, and they can afford to be a bit more patient if growth is expected to be a bit more resilient. And given inflation may pick a little bit higher, they'll likely keep interest rates unchanged in the very near term at least. That's all from us today. Thank you for watching, and we'll see you on Friday.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.